Us, Andrew Ostro.
Ostro.
You are the founder of PolicyMe. Thanks for doing this.
Yeah, thanks for having me on the show.
For anyone that is listening, what is PolicyMe?
Well, PolicyMe, we're a direct-to-consumer life insurance platform. So we provide an automated solution for individuals to come onto our website, get advice through our algorithms on what type of life insurance they need, or really if they need it at all, and then actually get quotes and buy the product directly from our platform. So we partner with Canadian Premier Life Insurance Company to develop our own life insurance product that we can sell directly, and that's what we provide our customers on our platform.
You're actuarial by training, I think I read.
Yes. So my background, initially, I was an actuary. I did that for a few years. I worked in the pension consulting world at that time. I wrote all my exams, got my designation, and essentially quit being an actuary the day after I finished those exams. I went to Oliver Wyman. I worked in management consulting, but exclusively in the insurance practice and mainly in the US, but a little bit in Canada as well. And then came back to Toronto and started this company in 2018.
How come you started PolicyMe? What was the idea behind it?
Yeah, so at the beginning, it was actually quite simple. We had seen this direct-to-consumer model work a little bit in the US, not that well. Still, the overwhelmingly large majority of sales were occurring offline, but we started to see a little bit of traction occur in the US. And we felt that we could take that model, bring it to Canada, but do it in a different way where we focused more on the advice and education to the customer and the upfront confidence in the buying process to sell the product. Because essentially what we were seeing was the core issue wasn't that life insurance was being sold offline. Obviously, it was only a matter of time till it moved online like every other industry. But we thought the core issue really was that people were getting poor advice. So if you think about it, I always like to compare it to buying a car, right? You go into an auto dealership, you go talk to a sales rep there, you know that sales rep is not looking out for you. You know they're working for the car. They're going to try and sell you whatever they can. And you have your guard up, right? You know, you need to do your own research. You need to take everything they say with a grain of salt and make your own decision on what you should be buying, how much you should be paying, what features you should be adding, anything like that. But when it comes to life insurance, the customer goes to an advisor, a broker, whatever you want to call that individual, and they're under the assumption that that advisor is going to be acting in their best interest and looking to that person to provide them with guidance on what to buy. But the problem is, just like the auto dealer, that advisor is paid by the insurance company, not by the customer. So they get paid when they sell, and the more they sell, the higher they get paid. It's directly correlated. It's one-to-one. The higher the premium, the higher the customer costs, the more money that advisor broker makes. So I'm not out there saying every advisor is acting poorly or not acting on behalf of the customer, but there's an embedded incentive in there. And it's human nature that when you see more money can be made, you're going to lean more towards that spectrum. And what that ends up creating is a world where customers are often oversold, whether that's too much coverage or the wrong type of coverage, which is really dangerous because you're getting too much of one thing and not enough of another. So you're leaving yourself exposed to the actual event and paying more than you need to. So we looked at that problem and said, okay, well, what can we do to fix that? We kind of recreated the advice algorithm. So what does it mean to give advice to someone? What does advice look like in a best interest world? And how do we scale that? And we scale that through automation, through technology, through building a platform where we didn't need a human involved, and we could take that advice framework, digitize it, and apply it to the masses.
You're a pretty young guy. You maybe don't need life insurance. How did the idea strike you?
I definitely need life insurance. I'm 35 right now. I have two young kids, so I'm the prime candidate to buy life insurance. But when I started the company, I wasn't. At that time, I was single. I didn't have any kids, and the type of person who, if they came to our platform, went through advice algorithms, the answer would be, do not buy this product. And we're actually quite unique in that sense, where we really hold true to what I talked about earlier in terms of putting the customer first and prioritizing the advice, that when a lead comes to our site, we're willing to turn them away because we really don't feel that our product is the right fit for them, which really I'm quite proud of and really holds true to what we really believe in.
Don't ask the barber if you need a haircut, in other words.
That's right. You know what the answer will be, right?
Yeah.
Yeah.
Things are going pretty well for PolicyMe. I think I read that you guys just completed your last financing.
Yeah, so we've done two main financings to date. Our first one was our seed round, which we closed in February 2020. That was a 3.3 million raise, and we're just about to announce the close of our Series A, which is an $18 million round that we've raised over the last 12 months.
And when you get money like that, what does it go towards? Why raise so much money?
Yeah, so that's it's a great question, and I think that's one of the things. It's very easy to get caught up in, oh, the money's available, we can go get it, let's raise as much as we can.
Mhm.
And we've really tried to stay away from that and really focus on keeping that efficiency, keeping that mentality of we spend what we need to, not what we have. And that's kind of how we came up with the number we needed. But to get into the specifics, it's largely to invest in our team, in our product, and our capabilities. So today we offer a single product, term life insurance. We're also in the process of building critical illness life insurance, which will be our second retail product, which will be on the platform in the next 2 months. But now we're starting to look at not just being direct to consumer, but partnering with different businesses, with other insurance companies, with other businesses that have potential leads to sell our products in an embedded way through their sites into their customers. And that requires continuing to invest in our capabilities to build more products, but also more features and more customization that allows us to work with other partners. So that's where a good chunk of the money is going to, really our product, our technology teams, our engineers to build, and then also starting to really look at geographical expansion. So today we're everywhere in Canada except for the French-speaking provinces. So Quebec and New Brunswick are the two that we're currently not live in. Part of the money is used to build up our French capabilities, launch in those provinces, and then also look at the US and looking at where we can launch as well, which states make the most sense. So the geographical expansion, the product capability build, those are the two main uses of the new funds.
For the layman listener who may be out there, in a nutshell, to explain it simply, a customer would log onto the computer, create a profile with the company, fill out a bunch of questions, and get their insurance code back pretty simply.
Yeah, so we actually don't even make you create a profile. You can go right onto our site and within seconds get a quote for what your life insurance would cost. If you want a recommendation as well, that's about a 5-minute process, but that's embedded right in that journey. So you can go right to the quote or go recommendation to quote, depending on how much you know or what you're really looking for. That quote, our product is priced about 5 to 10%, sometimes 15% cheaper than the next cheapest life insurance company or the next lower cost life insurance company for our product. So we're able to get the price quite low. You get a quote. That quote is likely going to be about 80% accurate, meaning 10 to 20% of people will either not get approved for the product, unfortunately, and those are largely people who have significant medical histories, or a few percentage of people will actually get approved, but at a slightly higher price. So again, about 80% of people will actually end up getting approved for the price we quote them on, one that they get within seconds. Once they see the quote, they can then click to apply. The application is another 10 minutes or so. We go into medical history. We go into some of the lifestyle questions. Essentially, you can think of it as us trying to figure out in basic terms, like we're trying to predict your mortality risk. We're trying to understand what is the probability of you passing away in a given year? What is your life expectancy? Different elements like that can help us determine if we're able to offer you that best price that, again, 80% of people will get. And generally, mortality risk is quite low, especially when you're dealing with 35, 40-year-olds, healthy people. The chance of dying is like a 1 in 2,000-3,000 event in the next year, probably even lower than that. So life insurance is quite cheap, right? When you can get 500,000, $1 million of coverage as a 35-year-old for $20, $30 a month, it's not expensive because that probability is quite low. The problem is if that event happens, the financial implications on the family are really high, which is why it's really important to get the product, but not that you need to spend a lot for it. But that was a bit of a digression to get back into the process there. So they click to apply, 10-minute application, they go through those questions. From there, we give an automatic approval to about 60% of people, an automatic decline to about 10%, and the other 30 will need some additional underwriting. So the 60% who get automatically approved, they can bind their policy right then and there. So click to sign their policy through DocuSign. pay with a credit card, and that's it. And they're off and running, and the policy is in force. The 30% or so that are referred, those people generally need to do something a little bit extra. It could be a follow-up question. It could be us getting medical records from their doctor, or in some cases, it could be us sending a nurse over to their home to collect blood and urine. It's not that common, but we do need it for certain cases. Again, it's not the norm. It's not the majority of people, but people who we find that there are some medical issues, instead of turning them down, we try and do all we can to investigate a little further with the hopes of trying to approve that customer for that best price.
In the case where something does go bad and a policy needs to be paid out, how do you convey trust to the customer? What financial institution is going to be paying those claims on the other end of things?
Yep. So we are not the life insurance company on record on the contract. So our partner right now is Canadian Premier Life Insurance Company. So when we sell a PolicyMe life insurance product, we're actually selling life insurance policy is really just a contract between an individual and a company that says, I will agree to pay you X dollars per month over this period of time. And if I pass away during that period of time, you agree to pay Y dollars to my family. So what we do is we sell that product, but it's actually a contract between the customer and Canadian Premier Life Insurance Company. They're an A-rated insurance company. They're owned by a massive US insurance company with a ton of assets. So they pay out like 99.9% of claims, some absurd number of claims where you're really just dealing with heavy fraud that gets declined. So as long as you were truthful on your application, didn't blatantly commit fraud, and fraud can be something like where maybe you had a heart attack last month, and when we ask you about it, you say you've never had a heart attack, when clearly like that's something that you're hiding because you're trying to kind of beat the system a little bit. So as long as you don't do anything like that, it's like essentially guaranteed you're going to get your payout. I mean, that's kind of how we convey our trust. Is it's not us paying you. It's not a startup that is raising capital. This is an extremely well funded with a lot of assets and big insurance company that is essentially behind the scene here on the hook to pay the claim.
The critic might say that, why does the insurance company just offer this automated process? But it sounds like you guys have some proprietary software or something along those lines.
Yes, that's right. So I mean, it's actually quite difficult for an insurance company to innovate in this space for all the reasons you would think. Right? I mean, starting their big financial institutions just aren't set up to create innovation. They're not set up to build good technology. They can't do it cheaply. So they've tried. I mean, there's a lot of insurance companies out there that have direct-to-consumer products that they sell on their own websites that have tried to say, like, we don't need a partner like PolicyMe. We can go direct to our customer. And for the most part, they've failed. I can't think of a single use case in Canada or the US, really, where a big life insurance company has really succeeded at offering their product on their own website without a partner with a company like us. So I mean, when we look at what we charge the insurance company and what our fees are versus like the penetration we're getting, the conversions we're getting, the savings we're generating by us owning the operating model, us paying for the underwriting as opposed to them, it's a no-brainer for them. I was like, why to partner with someone like us, get more sales, get more revenue, or have lower costs per sale, and not have to build on their own. It really does make a lot of sense for the carriers. And now that's what we're starting to get into. We're starting to look at different carriers, seeing like who else can we partner with and what in different geographies, and really take our model and expand it.
Do you worry they're just going to learn all your trade secrets and then hire a team and do it themselves?
Not at all. I mean, for the reasons I talked about earlier, like we're an open book. We don't keep anything to ourselves. We're happy to share the secret sauce, so to speak, or get into the weeds on what it is we do and how we operate. Maybe being naive, but I really don't see an insurance company being able to replicate what we can or what we have. And really, there's no reason for them to do it, because as I said, when you look at the economics of what we charge them versus what they'd be paying to do it by themselves, it just makes a lot of sense.
Or maybe buy you guys someday down the road.
Maybe. I mean, that's always something you think about as an entrepreneur when you start a company, is what's the exit, right? How do you get liquidity? How do you get money out of this business? It's tough. I mean, there's generally two routes that most startups go down. Like there's the IPO route and there's the acquisition route. Maybe there's some other minor deviations of those two, but for the most part, you're going to kind of going down one of those two paths. And I think there's usually a lot of pressure on entrepreneurs put on by investors and VCs to kind of pick that path early, or at least have a preference or an idea of which path you want to go down. We haven't really. We've kept our options open. We're really just focused on creating value, building new products, new features, growing the company, and we kind of think that exit will really solve itself. We're not really at a stage yet where we're so focused on what does the exit look like in the next couple of years.
In terms of PolicyMe's business model itself, the company earns revenue from charging a fee to the customer to complete the insurance questionnaire. And
no, so we make money from the insurance company, but we're making our money on, it's largely flat fees, fixed fees for operationals, to execute the underwriting, to do the servicing, to essentially be the infrastructure of the insurance company. So we think of ourselves as an insurance company without capital and without the regulatory paper to be an insurance company. So we've kind of outsourced those components of it, whereas we've kind of built the infrastructure of a monoline, or I guess now two product line insurance company that we can handle all the operations. So for us, we don't really have that incentive to oversell or to sell big policies. We're very much focused on like selling to the people who need it. And what they buy really doesn't matter to us as long as they're from a financial perspective. So we could really be focused on making sure they're buying the right product.
And the fee is kind of a flat fee then paid out by insurance company on a volume basis then, or?
Yeah. So it's a couple of things. It's per sale. So we do, and there are some components of like being upfront versus it being trail. So we get some of our compensation is paid to us on day one when we sell the policy, and then additional compensation is paid to us as that contract remains intact. And these are generally anywhere from 10 to 30-year contracts that the customers are signing with the life insurance carriers, but they're very much one-sided to the customer's benefit. And what I mean by that is the price is locked in for the 20 years. Let's take an example where someone buys a 20-year policy. The price is locked in for 20 years, meaning the insurance company can never cancel from their end. They can't change the price on the customer. Someone can be healthy, buy the policy, and a day later be diagnosed with a serious medical condition, to which point the risk of passing away obviously increases, and the insurance company cannot change the price on you at that point. They have to maintain that for the 20 years. Yet the customer at any point is allowed to cancel their policy, stop making premiums, and there's no penalties, no cancellation fees, anything like that to get out of the contract from the customer's perspective. So there's generally been, and that's true for any insurance company, not just us. So historically, there's been some issues in the industry where brokers who get a lot of their compensation up front have an incentive to kind of say, hey, it's been a couple years, customer, like let's cancel this policy and let's go get you into a different one. And obviously insurance companies are aware of that, and they have to price for that. They have to assume that they're going to pay these big commissions, and a good chunk of their customers are going to cancel early. And I call that broker-led cancellation, where the brokers are essentially advising the churn. And that creates some stress on the pricing model for the insurance companies, where they essentially have to charge more to make up for that. Whereas in our model, we don't have that. We're not charging the insurance company these high upfront fees. We're saying we're in this together. We believe in the longevity of the customer. We believe that once we sell the customer a policy, it'll be the right policy for them for a long time. And we're not going to tell them to cancel in 2 years, and we don't want to be incentivized for them to cancel in 2 years. And that allows us to essentially defer a lot of our revenue, a lot of our compensation later on in the policy. So we have a vested interest in the customer continuing to make payments and continuing to hold that policy. And that allows us, through with the carrier, to actually charge the customer quite a bit less, because there's a lot lower cancellation risk in the model.
And you're not compensated as much on the larger commission style traditional model, where the bigger the policy, the more you got paid. It sounds like it's more just a flat fee.
Yeah, that's right. We think of it more as like, what's the number of sales? Like all our metrics are based on number of sales, not based on size of policies.
Things have changed in the last few months. Interest rates are going up, making it hard for tech companies, which I think you guys would call yourself, to survive and do well. How has that been for you guys to navigate the changing economic landscape?
Yeah, so it's to say it's been easy would be a complete lie. I mean, it's certainly been a very interesting 6 months. I think a lot of it for us was really around the May time period when it seemed like everything started to kind of fall apart in the economy and in the VC world. I mean, there are certainly signs of it. I mean, we saw a lot of tech companies in the public markets, stocks get killed last year, especially in insurtech, right? Insurtech, I would say, was probably leading a lot of that, where there are several examples of insurtech companies that had recently IPO that just got crushed in the public market. So it was also a time when we were out in the market looking to fundraise. We started our Series A fundraise January-ish when things were kind of at its peak, and then like kind of went through that process while the economy and the tech world was falling apart. So it was definitely an interesting perspective for us to see that. And it definitely changed our plans a little bit. We ended up raising money through different sources. We got a little bit more creative. Instead of going after that big VC lead to fund 80% of your round or whatever it is, write that huge check. We built it up with smaller checks, got to the number we wanted to, but tapped into some of our strategic partners, took on some debt, looked at different ways to kind of raise that capital and get us the money we need, and also really reprioritize what it is we were going to be doing. I think it became very clear to us at that time that trying to market our way into growth was just not a good approach. It was something that the VC world had been valuing quite a bit over the last few years. And we fell victim to kind of thinking through, okay, that's what the VC world wants to see. That's where we're going to go, even though we kind of always knew it's not how you build a strong business. So we were never fully in there, but I think this kind of gave us the focus to just take a step back and say, okay, we don't need to play both games now. We don't need to solve for what does the VC world want and what does a good company need, because those two things were very different for a long time. Instead, we can say, okay, the VC world is now coming back to reality, and they're actually valuing what the same metrics that a good company would have. So it kind of allowed us to say, okay, forget about this other perspective. Let's just focus purely on ignoring the VC world. Like, what does a good company have? What is good unit economics, a clear path to profitability, all the different elements that lead to good, healthy, successful companies, and allowed us to just focus holistically on that, which meant cutting a few different projects that we originally planned, which was not easy, right? It's very difficult to tell employees and team members who've spent months working on something that it's going to be put on pause right now, put on hold, because we just can't continue to hire and just spend as if we had unlimited money. So it meant definitely reprioritizing, which was difficult, but I think the team really reacted well. I think seeing what was going on outside of our company with different tech companies doing layoffs and different elements like that, we didn't do any of that. I mean, in fact, we still have hired throughout all this at a slower pace than we initially planned, but we've still been adding to our team members. We gave raises at performance reviews consistent with what we had planned, and so we've really continued to invest in our people and our teams. We've just made sure that we're just very, very focused on what it is we build and what it is we prioritize in our roadmap.
From your perspective as a company founder, what would be the top 2 or 3 points to running a successful business? For instance, cash flow or profitability or earnings. Are there maybe 2 or 3 things that you focus on?
Yeah, I think I don't know if it's profitability, but it's not current profitability, right? I think if you try and create a world where like you don't need any external capital and you're fully self-sufficient from the get-go or very early on, you definitely inhibit your growth, right? There's no doubt about it. Like, it takes money to make money. While that might not be as aggressively true as it was, or as people were saying about it, it still holds a lot of merit. And there's some element of it. You have to take some risks. You have to invest. You have to be willing to spend money and burn money to build and create something of value. So you don't think it's profitability in terms of like, okay, well, what's the quickest way to become profitable? Because you're going to miss out on the big opportunities. But I think you have to have that in mind. And one of the things I've learned is the mindset we were in earlier on was very much like, we'll solve that problem later. Let's make sure we're building value, we're building good things, we're building products that people need, and profitability will kind of solve itself. I think that is absolutely the wrong approach as well. And it's got to be, you got to like kind of map it out in your head or on paper. What are the next 3-4 years look like? How does this become profitable? Because it's very easy when you ignore it, it's very easy to take a step back and be like, was there ever really a path to profitability here? Or was I just kind of lying to myself or convincing myself it was there? Because you can get so caught up in growth numbers. And you can see 20% growth this month, 15 next, 30 the ones after that. Before you know it, you're at, I think we grew 300% in 2021 or 350% in 2021. And you can get like very caught up in like, wow, these are really good signs. And this is all that matters. But you have to bring back that lens of like, is it profitable growth? Is there a path to profitability? Does this even make any sense? Are we just blowing money? Are we spending money that we're going to just have to go back to the markets for? Those are all the elements that I think are really critical to think through when you're starting a company.
I was watching a good podcast, or I was listening to a good podcast the other day on Tim Ferriss with Andy Radcliffe from Benchmark Capital, and his two comments about a tech startup were, how do you know you've achieved product market fit, and how do you know if you have product market fit? So that's kind of a tech world sort of lens to look at things. Have you guys thought about things in that sense?
Yeah, it's actually an interesting point to bring up because I think we've recently found product market fit in a world where we may have thought we had it before. And I think product market fit is the VC world talks about it as a binary concept of you have it or you don't. And I think there's a scale to it for sure, right? I think there's like really strong product market fit, and there's kind of like mediocre, or it's there but it's not a multi-billion-dollar company product market fit. So what I think we had when we built the company, started in 2018, we started really going to market end of 2018. 2019 was kind of our step in, get some sales. And I think 2020 was our first like really strong year where we saw a huge amount of growth. And I'm talking like 700, 800, 900% growth. Now it's all relative to what you're starting from. And you're starting from a small number, it doesn't really mean much. But my point is that we were really starting to hit something where we had very meaningful sales, very meaningful revenue. And it was very clear that we built something that people wanted and people were willing to use and buy. And I think that's really what the definition of product market fit is. So from there, I would say, yes, we had achieved it. But I think we then found later on that our growth and scalability was somewhat limited with that model. So sure, we had found people, but with new competition and with maybe the next set of making a more difficult task to find the next set of people wasn't really fully there. And I think recently we've started to really double down on our B2B2C angle of this and looking at who else can we partner with, where can we leverage, take what we've done, which is really build the best converting life insurance product out there. And so instead of us finding leads exclusively, can we use someone else's leads? And I would say over the last month or two, we've had about 10, 15 conversations with CEOs and leaders of different businesses, whether it's insurance companies or fintech companies or other startups. And it feels like every single one we're having, like the call ends with like a massive opportunity partnership waiting for ourselves. And this is a whole other level of product market fit where I look at this and say, okay, we had it on the B2C side. How strong was it? Who knows really, but it's very clear to me now that we have something that tons of different businesses want and need to actually deliver to their end customers. So it's the same model, different model, same product, same idea of delivering high value, low cost life insurance to individuals, but just the approach of how we get to those individuals by leveraging other businesses is what I really think is highly scalable, and where I really feel like we've struck a chord here and found very strong product market fit.
Well, that's a great conversation. I think that really gives a high level summary of PolicyMe and the growth trajectory you guys have been on and whatnot. What's the biggest opportunity for PolicyMe going forward? You kind of touched on it just now, but where do you think the company's headed?
Yeah, I think that's That's where it is. It's the B2B to C landscape for us. We're always going to focus on our B2C business. I think when I think about what we've done is we built this high converting, continuing to be fully optimized digital life insurance product through by understanding the customer, by having our own customers, by speaking right to the customers, by optimizing for them, developing for them. And I think that's what drives our machine. So we'll never forget that, and we'll never stop that. But that enables us now to get into this B2B to C world where we can take all our learnings there and hand out products over to other businesses and really scale it from that perspective. So I think when we look ahead, we'll likely be a company that will continue to have a direct-to-consumer brand, a B2C product, but be very big in the B2B2C space, which will spur a lot of our growth as we look towards the next 2 to 3 years.
Maybe creating products the customer doesn't know they want yet.
Yeah, I mean, it's tough, right? Because I think with life insurance, it's not so much the product innovation. Look, there's certainly some things that can be had there, but the products are simple when you break them up. It's really the way you engage with a customer, the way you sell the product, the way you position your advice, the way you get someone insured, which is where a lot of the innovation occurs. And it's taking these products that have a very antiquated way of the buying process. And that's a lot of it, right? Like most of your experience with a life insurance product is the buying of it. Once you buy it, I mean, you hope you never use it. And maybe, I guess there's a small chance you pass away and your family needs it. But a lot of the use is in the buying process. So that's where that's where a lot of the innovation really needs to occur.
Well, I think that was a great conversation. I really appreciate your time explaining the business and telling everyone about it. If somebody wanted to learn more about PolicyMe, where can they find more information on the company?
Yeah, so we can go to our website, policyme.com, or reach out on LinkedIn to me directly or to our company, any which way they want. We're always happy to have the discussions and happy to share more about our company.
Awesome. Well,